Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, April 1st, 2016. First, a programming note. My wife, Dr. Marie Feldberg, she's a psychologist and a coach, will offer pointers on emotional control and sticking to your guns while trading in the very near future, hopefully next week. Then back to stocks. Stocks are still rising, but in a bear wedge channel formation. We'll look at breadth, which has improved, but volume still lacking on this rebound of the multi-year lows, actually. Bonds broke out to all-time highs, which is, in my book, equivalent to lots of fear in the market. The dollar is at a very important support level, and we'll see where it goes if it breaks it. So far, gold has not taken advantage of the weakness in the dollar, and we'll look at oil, which failed previous resistance, which is a pretty logical resistance level. And finally, we'll finish up with natural gas, which still may have some upside room to run. All right, we're looking at the S&P 500 ETF SPY on a daily time frame. So I showed this chart many times in the past. Basically, we're at 52-week lows here, and then we had a pretty powerful rebound. This is about 15% move of the lows to the highs of this rebound. We're approaching all-time highs, which are, I believe, here somewhere. So to me, this is still a bear market rally. I outlined my case for this being a bear market. My model, the long-term model market breadth index is still pointing to continued bear market. And what I mean by bear market is a series of lower lows and lower highs. I know there's a conventional definition of a bear market, which is 20% decline of the highs. I'm not a big fan of that definition. So far, this is a lower low, and we're not seeing a higher high yet. In any case, this is a powerful rebound. So far, we had several attempts by the bears to push the prices lower. Here, another one here. Very mild attempt here, but the gap was close. So I thought this was a breakaway gap, possibly a breakaway gap. Maybe this was an exhaustion gap. In any case, it was already closed, so it's a moot point. So we'll see where I'm looking basically for signs of failure, and we have resistance from these peaks here, so it's pretty obvious place to fail. Down below we have several breadth indicators. Advanced decline line had indeed broken out, so that's a positive sign. So number of stocks are pushing higher. That's a good sign. However, again, the volume on this rebound is lacking, and you can see that this is kind of like a bullish divergence here, but here we don't have the divergence just yet. In other words, this high here is still below this high here, so there's no bullish divergence. If it breaks out, that will be a very positive sign. The same actually goes for on balance volume. I have not seen a higher breakout above this level just yet. Next, let's look at broader NYA index. Okay, this is NYA, NYSE Composite Index, much weaker as you noticed than the S&P 500 itself. Whereas the other one, the S&P 500, was at 52-week lows. These are actually multi-year lows. So we have made a series of lower lows and lower highs, and this so far is a lower high. If or when we see a higher high, for example, a breakout above this level, that would be a very positive sign, and something that I will certainly take into consideration. As of right now, again, this is a bear market rally to me, and actually we can see that so far it's there is quite a bit of resistance in this area, maybe from this formation here. Down below, once again, I have several market breadths and volume indicators. The on-balance volume, you can see, has not broken out to the upside versus the advanced decline line itself. So the number of stocks are certainly pushing higher, and we can see a bullish divergence. But again, for volume, I still don't see any kind of bullish divergence, and this is still confirming a lower high. Down below we have here NYSE stocks above 20% EMA, 50% EMA, and 200% 200-day EMA. You know, as far as the 200-day EMA, we kind of stolen the 54% mark. So ideally, we should see a breakout above 60%, possibly even 70% to kind of more confirm that we're maybe in a bull market. The percentage of bullish percent index is certainly improved. We're now above 60%. So again, as far as stock market is concerned, I'm still looking at this rally as a bear market rally, and if it does roll over, we could easily see a leg down, you know, below these levels from September, October lows, and possibly even take out the February and January, February lows of this year. Okay, let's move on to bonds. All right, this is 20 plus year Treasury bond fund, TLT. I think this is a bullish security. We're hitting all-time highs. We just hit all-time highs in February, and then kind of corrected in a wedge sort of pattern down to the 50-day moving average. I think here we tested a breakout above these levels here, and I think so far successfully. And if this is indeed a falling wedge and this is a breakout, then we have already broken out of this formation. So that's, I think the door is open to challenge all-time highs again in a not so distant future. Down below we have unbalanced volume, which is showing bullish divergence. So in other words, this peak here is is lower than this peak here. So in other words, the price made a lower low, but the volume made a higher low. So that's a bullish divergence, and this is showing, I think, that there's quite a bit of interest in buying bonds, and most likely as a protection against stock market declines. Okay, this is AGG, iShares Barclay Aggregate Bond Fund, very diversified bond fund also. This one is even more bullish than the previous one, TLT. We had something similar. First of all, we had a breakout here in February, and then a continuation to all-time highs, and then a correction in a form of a flag or a pennant. And then another breakout, another all-time high here, slight correction, and another breakout to all-time highs this week. So even this Friday, even though, you know, intraday we put in an all-time high as well. Same thing here, on-balance volume is really showing nice volume patterns. So we have a confirmation of this all-time high with with a high in on-balance volume. So again, this is showing interest in buying bonds, probably because of the potential for a decline in stocks, because we're again approaching all-time highs for stocks. Next chart, briefly, I'll show this is the same AGG, but on a weekly chart, going back a couple of years. Looks like to me this could be like a triangle formation, or also like a flag or a pennant. Also a breakout here in the beginning of February, and continuation to all-time highs. In fact, this Friday's close is this is a very bullish looking candle. Closes next to the all-time high. So also same thing for unbalanced volume. Looks on the weekly chart. Also looks like we have a bullish divergence, or rather not a bullish divergence, but a confirmation of this all-time high. So to summarize, I think bonds are very bullish. Maybe we get a pullback in bonds, but I think the general trend is certainly up. All right, switching gears a little bit. This is US dollar index, USD, also known as DXY. So yeah, we came down pretty hard, didn't we? From almost 52-week highs here, came down in a series of legs down. Now, this is sort of an important level because so far I don't think we have broken this support from mid-March and April. We have two candlesticks sticking, two tails sticking out from from the bottom here. So maybe we held the support for dollar. I don't know yet. If we do break the support, most likely I see a retest of this level 92.52, and then next chart I'll show why that level is very important. In fact, it's critical. As far as the euro versus and the yen, because they're the biggest components of the dollar index. So these are 52-week highs for yen, and this is despite really incredible, quantitative easing in Japan. And despite the printing of just enormous amounts of yen, we still see, 52-week highs in yen. Again, yen is considered a kind of safe haven currency, so I wonder what is happening there. As far as euro is concerned, it's a mixed bag. Basically, this entire year is a consolidation, and it's just a sideways action. So in the next chart, this is a weekly chart going back 3 years. So we had a breakout here in in 2014, and then run up to 2015 March. Here to the local this 52-week high here, and then kind of like this whole time since then, since last March, really, we had a kind of correcting sideways patterns here. Now, currently we are falling in sort of wedge pattern, and this could also be considered a channel. So right now we're near the the bottom part of the channel. So if people are going to be buying based on the fact that this is a channel, maybe this is a good place for them to buy. But if we do fail here, I think this level is going to become very important, 92.52, around this level. So if we do break down from here, from $94 area, we could easily come down to the 92.52 and possibly break it. So if this level doesn't hold, most likely this breakout would have failed by then. What this would mean is that euro would be breaking out to 52-week highs, and yen most likely will be doing the same thing. Euro is actually quite important. I think it's about 50% of US dollar index. So several levels to watch. Basically, we are at one of the pretty important supports right now. If we do break it, next up most likely will be this $92, $93 area, and if we don't hold it, this entire breakout most likely would have failed. Next, let's move on to the commodities part of the presentation. Okay, this is gold daily spot price chart. So interesting is that this week dollar actually fell quite hard, but in the same time frame, in the same week, gold only was able to rally about half a percentage point. So I wonder, what's happening here and how come the gold is not taking advantage of the drop in dollar, because usually gold and dollar are inversely correlated, so it would make sense for gold to gain significantly more, but in fact it didn't. In fact, this Friday's candlestick doesn't look particularly strong. I mean, this one looks better. I think could be like a hammer candlestick, but I think if we do break 1206, we could of course fall down. Well, that's an easy level to 1190, 1180. Take that one, retest this breakout level. And this is a breakout above this level here. So if we take out this breakout level, next up would be probably 1140. Around the 200-day moving average, and then next up would be this breakout level from January breakout. If we don't hold there, we could easily make multi-year lows again, and then in that case, we may completely reverse this entire breakout. So interesting time for gold. I think it all depends on the dollar. If the dollar holds in this, in the previous areas I showed, and then rallies, gold will come under pretty strong selling, I think. Vice versa, if dollar continues its downward march, then gold may actually hold support and break out even further up. Okay, this is GDX, Market Vectors Gold Miners ETF. A very similar picture to gold itself. Had a breakout above this level here. This is a breakout. Continuation higher. Rejection candle. This actually quite bearish rejection candle because we had a push higher during the day. It was sold immediately and the prices closed near the low of the day. So certainly doesn't look good. Then I had a big gap down here, right there. Then we had several inside days here. So after this gap down, we had a big red candlestick, and another next day we had a candlestick inside the first one. It resolved to the upside with a breakout above this candlestick, but then the next day we had the same another inside day. In fact, so far I don't think this inside day has been resolved. So right now we're just kind of bouncing around here sideways. It really all depends on gold. If gold and dollar, like I said, if dollar rallies from here, gold will most likely go down and take GDX together with it. Now this is a pretty steep rate of ascent, so it's even if it's bullish now, and I do consider gold and GDX bullish, this is still like I would not be buying up here. I would be looking for a pullback and look for a pullback and then a buying opportunity. But again, this is a support level here at 1886, 1850. We break that easily, we can collapse down to the $17 area, which is a breakout level above this level. Also, there are gaps down below here around the 200-day moving average, and another one way down below here. So, gaps they really need to be closed, but we don't know exactly when. Maybe they'll be closed now, maybe they'll be closed in 20 years from now. I don't know. But in any case, for now, I see kind of like a sideways consolidation, and if the dollar drops, most likely we will see a breakout even higher. However, if the dollar falls, or rather, what I meant to say, if the dollar rallies from here, we could easily see gold and gold miners come under pressure again. We'll see where it goes, but for now, there's not much happening, just sideways consolidation basically. This is oil, West Texas Intermediate, light crude, spot price daily chart. Multi-year lows here in February, a rebound in the form of a rising wedge. Looks like now we had a rejection at the 200-day moving average with a long selling tail out of the top, and then a confirmation drop several days later. We had pretty much nothing but selling all this week. This candle looks quite bearish. Again, we had selling throughout the day on Friday. So, depending on how you drew the rising wedge, maybe you drew it this way, maybe you drew it from this low, but I think either way you drew it, both of those wedges were broken this week. So I'm guessing we're gonna retest this 50-day moving average to about 34.5, and this also corresponds to this resistance, well, now support level. If we don't hold it here, most likely we're gonna retest multi-year lows again. Sometime in the not so distant future. I wanted to show a nice bearish divergence here. This is pretty clear here. We see a lower low in unbalanced volume versus this low, while the price hasn't even gotten there yet. So pretty bearish looking chart at this point of the game. Right, that's it for West Texas Intermediate. Oh, another chart I wanted to mention for West Texas Intermediate, oil. So this is a long-term chart going back 3 years. I just removed pretty much everything and just left the price itself. Sometimes it's actually easier to visualize the patterns here. So I think that rejection was at pretty logical level at around 42.5. And you can see that this is around where the support was found in the beginning of last year, and we had a couple of rebounds. But then in the middle of last year, we broke that support, rebounded, and broke it again. So this looks like an important level for oil, around $42. And for now, I'm seeing this acting as resistance. We could receive a rebound and retest of this resistance again. In fact, it quite often happens. You can see it happened right there. We retested the resistance twice. But for now, I don't see really a bottom in oil. Usually when the oil bottoms, when the security bottoms, like for example here, this was a great opportunity for oil to bottom, but then it broke the support. So if it held the support and rallied and maybe made a higher high relative to this high, then I would say, okay, definitely we're bottom in action here. But so far we haven't. We really broke support, rebounded. This was really a feeble rebound and collapsed again. So and then this is multi-year low. So for now, I don't see a bottom in oil, bottom in patterns in oil just yet. This is natural gas, daily price, a daily chart spot price. Also multi-year lows for natural gas here, and then a rebound in the form of possibly a rising wedge. This candlestick here looks kind of weird to me. On the actual futures chart, I don't see this weird looking gap here. And then continuous contract, I don't see this continuous, this weird looking gap. So this could be I don't know. I think it's one of those things that maybe eventually be adjusted, this price here. But for now, it's there. But in any case, I think that this resistance is not there because of the aberration in the price data. I think a bigger resistance is up here at $2.17 or so. And we'll see if natural gas gets there, and if it if it fails there. Next resistance levels are right here at $2.31. Also, this is a 200-day moving average coming in here. And a really big, major, humongous, tremendous resistance is here at $2.15. And I'll explain why when I show the next chart. For now, I still think that natural gas is bearish long term. But there are some bullish looking signs. So we see a bullish divergence in on balance volume. So volume patterns are certainly helpful if you're trying to pick the bottom, long term. I'm not trying to pick bottoms, just to be clear. I still think this is a bearish security, so I'll be shorting it once the opportunity arises. But on the next chart, I'll show why this $2.50 is really, I think, very important for natural gas. And if it is able to clear this level, this would be a major, achievement, and we may actually see a new bull market in natural gas. So let's look at that chart now. So I featured this chart of natural gas last week. This is a weekly chart going back 3 years. And here's that $2.50 level. And even if you're not, very long-term trader, in other words, you haven't been in the market for a very long time, you could clearly see that there is something happening around that level. There was this breakdown right there last week, or rather last year in September. This level held on several occasions here. it almost got to $2.50 here in 2015. So there's a lot of things happening at that level. So also here in the very end of 2015, beginning of 2016, natural gas came up all the way up to $2.50. In fact, if I go back, I'll show you that this is it. This is that level right there. So that's the level I just showed. And it so far acted as a strong resistance, and we bounced back from it and made again multi-year lows just actually in March, in the beginning of March. Then again, I showed several possible bullish divergences on various indicators. This is a momentum indicator, RSI. You can see that we made the lower low here and the higher low here. Now, I take momentum indicator divergences with a very large grain of salt because most of the time they don't work out. But sometimes they do. So it's there on the chart. Money flow index is a volume-based indicator similar to RSI. Also, we're seeing a divergence there. This is a bullish divergence as well. And then accumulation distribution line, you can see a higher low as well. This is also a volume-based indicator. And like I said, just in previous chart on balanced volume, you can see a bullish divergence here on a shorter time frame. What it all means, I think, is that we're going to be attempting. Natural gas was most likely going to attempt to push higher. I don't know where it will fail, but I will be still looking for failure signs. However, if it does clear the $2.50, we could see a new bull market in natural gas. That's it for this week's recap. Thanks for watching. Stay tuned for next week's video and possibly a separate blog post from my wife Marie Feldberg, who is a clinical psychologist and a coach also, and she might be able to help out people who are dealing with stress from trading and also stress from not following your own system and all the emotions that come with it. Again, thanks for watching and have another great trading week. Bye bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. You have Twitter, Facebook, YouTube stacked with accounts. You can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching and have another great trading week. Bye bye.